and also the participants to the webinar on global taxation. I do welcome each one of you and thank you for your time and keenness to share your post-COVID perspective with equally keen participants with us. Friends, we are connected today in the middle of a very raging lethal pandemic. Though the global scientific community is still Googling to come up with some kind of reliable tools to predict the expiry date for COVID-19 or to decode this coronavirus, which has caused this global pandemic. But one thing is very certain, all of us will perhaps agree that this is going to be remembered for different aspects of its devastating capabilities and also the side effects. Talking about the side effects, a behavioral scientist told me that what was once polite may be seen as rude, and what was once rude may be seen as polite. So that is the impact of COVID-19. So far as tax jurisdictions go, they will always remember it guzzling their entire activities worldwide. If you look at the kind of packages being announced worldwide by different tax jurisdictions, if we leave aside the Western or Northern Hemisphere, where of course there are the rich economies, but even some of the Asian countries, they have also come up with very large packages. India perhaps will be one exception, where we are still waiting for the fiscal package or maybe the cash rollout, etc. Mrs. Sridhar will comment about that later. But similarly for the businesses, the months-long lockdown actually have made it certain that post-COVID global economy is not going to remain the same. And if the businesses are not going to remain the same, so will the world of taxation. What may further make it more contentious potboiler is significant jump in the use of information and communication technology, of course, which has enabled the running of offices from home and also cross-border transactions. In other words, the size of the digital economy is inevitably going to go up, but the global issue of digital tax continues to be parked in a limbo. In this grim background, some of the economies which have already notified service tax on such digital transactions may be joined by many more. And I do not see OECD actually pulling off any sort of consensus on this issue in near future. So let me first invite Mr. Akhilesh Ranjan, the former member of Central Board of Direct Taxes, Ministry of Finance, to share his perspective on this issue. Over to you, sir. And I would also like to request you, sir, to touch what what has been reported about the US, that apparently US is feeling very offended that good number of tax jurisdictions have gone for this different kind of digital service tax, and India also opting for equalization levy. So over to you, sir.
Okay, yeah, thank you, Shailendra, and hello once again to all of you, the panelists and all the participants. Great to be with you all this afternoon. So yes, the COVID has really, as Shailendra mentioned, it has really changed the way we live, the way we think, the way we talk, the way we meet, the way we discuss. Everything has changed, and I don't know whether how well we'll be able to get used to the normal after all these months of speaking to each other on the phone and through these video chats. I never knew there were so many meeting apps that which were available. So for the tax, there are two types of impacts on the tax front. One is on the tax administration, and the other on policy. Now, on the administration side, a number of measures have been taken. There are measures required to be taken by the government to help out taxpayers in their compliance. There are deadlines which are required to be waived. There are penalty provisions which are required to be relaxed, because there are things which are beyond the control of taxpayers. There are some various things which are beyond the control. The government here has done taken a lot of measures. They have extended the time for payment of tax, or they have made it easy to get a certificate under 197, a tax reduction certificate. Various things have been done. Of course, I personally think that they could have gone much further, because I think one should not be so stingy at this moment. Why to go only up to 30th June when we know that this virus is going to be around even beyond that? And I think it would have been nice to straight away go and extend all dates up to 30th September at least. But in any case, I suppose the government can always take a call on that. So that's one set of measures that does create a problem, because all time limits in the law are they sort of harmonize. There is a system, there is a method in that, and when you take out some time limits and extend them, then it does impact the other parts of the procedure. So it will create a lot of confusion, but then there's something that we will have to handle when this whole madness ends, and I'm sure it'll end soon. But then, yes, there are problems created administratively for the administration, of course, for the taxpayer who is struggling to comply with the law to get his. If he is managing to do his business, then all his payments, the tax reduction at source, all these things that he has to manage. The other more important part is the impact on the policy front, and there well, I think all of you are fully aware of what's been happening in the world in the last couple of years. The BEPS project had come out with some very good results, very good recommendations, but then there were things that they did not address. The BEPS outcomes did not address the fact that countries could still have a very low rate of tax, or not a nil rate of tax, and therefore businesses could therefore take that route to suppress their profits and tax. Um, it didn't take care of the some aspects of transfer pricing of intangibles. More work was certainly required in the BEPS on that front. And more importantly, the BEPS did not address the issue of digital economy in full detail. The final report only said that there are issues which the broader challenges which can be sorted out later. Of course, when in countries like India and others started levying their own tax on digital transactions, the G20 again insisted that a consensus solution to be found. And here now we are at a stage where discussions are on. There have been many proposals from the US, from the UK, a proposal from the G24. Um, and the OECD has tried to form a unified approach in considering all these three proposals, and is trying to now work out the details. The G20 still insists that a solution must be found at the earliest, if not by the end of this year, then by early 2021. But because of this COVID, again, things have received a setback. I think the discussions are going to take much longer. I don't know whether it is possible to have a consensus solution by December end. It seems to be a bit too early. Um, but it is certainly a realization that uh, the challenges posed by the digitalization of the economy are very real. They have come up already in front of businesses and tax administrations, and now they promise to come up in more force. When people start doing businesses, more and more of business activities are reduced to digital transactions, or to digitalization, then all these issues will become more and more important. So I think the discussions that are going on the digital economy are now more and more relevant. Uh, and there, of course, you would be aware that when the discussion started, the US had come out with a proposal. They had talked about marketing intangibles. They said that, okay, in consumer facing businesses, we will allocate more profits to the market jurisdictions. And they called it in a very grand terms, they called it a reallocation of taxing rights. Now, as things stand, the unified approach is largely on the lines of the US proposal. But then it doesn't seem to be now a question of reallocation of taxing rights to that level. What is really happening is that perhaps the US only wanted to address one part of business activity, and the consumer facing distribution activity, where proper returns were not coming up, being taxed in the US, for example. Um, but then when the discussions went on to and try to widen the scope of of this tax and to bring in all types of digital activity, then in sometime in December 2019, last year, the US suddenly almost backtracked. They sent a letter to the OECD saying that, look, we are not comfortable with defining an alternate nexus. They said we are not comfortable with major departures from the arm's length principle. And if that is the case, then these are the two fundamental cornerstones of the new proposals, that you think of an alternate nexus which is not based on physical presence. It is based on some significant economic activity, and you think of a way of allocating profits which does not stick to the arm's length principle and the arm's length standard. You go beyond that to some extent. But then, if the US now said that we are not comfortable with any of those things, of course they said, we let us keep discussing, we will keep talking, and and that the US will accept whatever result is achieved. They will accept it as a safe harbor. Now, I'm still not very clear what they mean by that safe harbor. Probably what they mean is that then they will allow their industries, their businesses to then opt for the new regime voluntarily, but the US government or the US Treasury not signing on officially. So, but that takes the whole strength out of the discussion. Now, if we are coming to whatever solution, and the US is not signing on the proposal, then it is not a consensus solution really in that meaning of the term. And if that is the case, then why should countries who have taken unilateral measures, why should they then withdraw? Let's take India, for example. We had the equalization levy in 2016. In this last budget in February, we have expanded the scope of that equalization levy. Now, but we had always said that the moment we find a consensus solution which can address these issues, we will depart from these levies. We will stop them. But how do we do it now? If a solution is going to be something optional for companies, if it is open to a large multinational of US whether to opt for this new scheme or not, then how does any country think of disbanding the digital services tax regime? And that is why you see all the other countries also are now more and more, and with more and more force. The European Union has renewed its call for a digital services tax. Of course, in order to fund the post-COVID problems, of course, but then they are renewing it. There are other countries who are very firm, and Spain and Turkey and all are trying to implement that. So that's what is going to happen, and therefore I think we will have to then look at a world where we forget about the traditional ways of computing profits. There is nothing called a separate entity principle now, because we'll have to take a group's consolidated profits and find a way to allocate that profit into different jurisdictions wherever the group operates. Now that's it may sound very simple, but it's something extremely difficult to do. Firstly, to compute what is the global profit. Secondly, to then find the way, in what manner do we allocate that profit to different jurisdictions. Uh, uh, because that's what the unified approach was trying to do. But then that's something that, and in one way, these equalization levy and other taxes are also saying the same thing. That okay, you are in my country, you are earning so much of revenue from my country. I presume that there is so much of profit in that revenue, and therefore I ask you to pay so much of tax. Uh, that's that's the formula sort of approach that the countries are taking with this. So it's possible that more and more countries now try to come up with these sort of taxes levied on gross revenues, because they are not getting a solution which can effectively tax the income of these multinationals. Um, Shailendra mentioned about the U.S. Trade representatives' notice, let us say. Uh, I think the US is perfectly justified or in doing that. I mean, they are their companies are really at the short end of this, all these digital services tax. But then uh, if they are trying to uh, investigate the regime brought in by 9 or 10 different jurisdictions, what would be the what is the where is the scope for saying that there is some discrimination? How can just 10 jurisdictions, including the European Union, discriminate against US companies? The nature of the digital services tax in all these jurisdictions is different. Uh, for example, in India, we don't have we have a very low threshold, $250,000 of revenue, and the tax kicks in. Whereas in the European Union and the countries like Spain and Turkey, they have a threshold of 750 million euros for the group revenues. Only then will the tax system. So, can we really say that the Indian tax is targeted at some US companies? We are not even putting a threshold, a high threshold out there. We're not even we're right now after this March 2020 addition to the budget. In the budget, it's a broad tax, it's a broad levy which is targeting every sort of digital activity. Then can we say that we are only targeting US companies? I don't think that India needs to worry about the notice that has been given by the US. They have called for consultations, and I think the Indian government must talk, and that's we should always talk and explain what our levy is all about. And it must be made clear that there is really no intention of targeting some US companies. So it happens that some of the major taxpayers would be US companies, but the levy as such is not meant to be targeted at just some companies. So I don't think we need to worry, and I believe that even other countries like UK and all have already said that they are going to go ahead, regardless of what the US does. So it's going to be an interesting world now. That's the post-COVID world I was referring to, where there will be these conflicts and these tussles as to find the right way of taxing income. And I won't be surprised if 5 or 10 years down the line, we are forced to find a completely new way of taxation, something like what the IMF calls the destination-based cash flow tax, or something like that, which is because it is becoming so difficult and so impossible to use the same old principles in this new business models, and then to find a way of properly allocating profits in that model. So it's interesting to see what's going to happen. Right now, we can only say that let's the world community should get together. We should try and find consensus solutions, or not, if not solutions, at least some consensual approaches, which can then be taken forward at a later point of time. Maybe an interim solution can be brought out at this point of time. But I think personally, all countries will have to think very clearly of abandoning established principles of international tax, principles like the separate entity principle, like the arm's length principle, and then coming out with new ways of determining profits which can be taxed in a particular jurisdiction. So it's going interesting, but let's see what happens, notwithstanding what the US would try to do in their trade restrictions. Thanks. I think that's what I wanted to say. Thank you.
Thank you, sir. Thank you for making it very comprehensive, sir. And as you rightly said, that this world has to look for new ways, new tools to either to determine the taxing rights or to tax because the world itself is becoming so digital, and digital economy is going to occupy a major chunk of the world economy, GDP. So naturally, it's going to be the biggest challenge. We have the next speaker, sir, Mr. Rajit Prasad, one of the youngest advocates to be designated as senior advocate by the Supreme Court of India, and he will share with us, the post-COVID tax litigation perspective in India, and also, maybe the constitutional validity of equalization levy. Perhaps you would like to touch that.
Thank you very much. Thank you very much. Thank you very much. Good evening, all my fellow panelists, and the distinguished ladies and gentlemen who have come together today to hear us speak on how litigation is going to happen in the post-COVID situation. There are three, four very important matters which were listed in Supreme Court in the advance list before the lockdown happened. And these three, four important matters are going to be very widely seen by people all over the world as to how the Indian litigation in international taxation, the courts rule. The first matter which people probably are interested in is the equalization levy. The equalization levy, I mean, is totally based upon the perspective that it is not a direct tax levy, but it's a transactional tax. But generally what happens is in courts, one looks up the SSEs coming up with different kind of forms, and the revenue argues that you don't look at the form, but you look at the substance of what the levy is all about. Now we see that the equalization levy has been brought in by the government as a transactional tax. But if you look at it a little more closely, one could see that this transactional tax has been brought in. Why? It has been brought in so as to tax this digital operators, platforms who have kind of businesses all over the world. They do not have any physical presence. Therefore, the earlier kind of taxation regulations and rules, like your permanent establishments, your fixed place PE, your service PE, dependent agency PE, are not good enough to tax this kind of a new entity which doesn't have any physical presence in other jurisdictions. Therefore, if you look at the BEPS report, as a result of which this transactional tax was brought in basically to tax the income of these particular operators, the digital platforms. Therefore, if you look at how this particular, if you look at the source of this particular transactional levy or the equalization levy has been referred to as 92C of the Constitution, the first list of the 7th schedule. Now, if you look at 92C, 92C has been never notified by the in the Constitution. In fact, 92C has been deleted. Thereafter, we have 97, entry 97. Entry 97 is again something which is related to Article 246A. Again, Article 246A is something you will give the power to tax for your GST. Now, if you look at it more closely, you have certain amendments been brought in the Income Tax Act, where it has been specifically said that if you have a PE or you are being taxed according to your permanent establishment, you will not be taxed under your equalization levy. Equalization levy will not be there. Secondly, you have the 2016 equalization levy was in a manner whereby a tax was deducted under a kind of a TDS method. Now you have 1050, which has been brought in, which says the income of these digital platforms would be kind of totally exempted if they are paying your equalization levy. Therefore, I mean, if you look at it more closely, you would see that even though the government has said that the equalization levy is a transactional levy, it's the form which is in the form of a transactional levy, or it's the equalization levy is in a form of a transaction levy. But if you look at the substance of the levy, you would see that in actual substance, what the government wants to do is to tax the income of these digital platforms who do not have any physical presence. Therefore, I mean, the substance of the levy is an income, is a tax on the income. It's not, I mean, even if you have a form that you pay 2% of your gross revenue, but why? That the 2% of your gross revenue is basically a measure to see what is the portion of the income that you have in our country, which is to be taxed. Therefore, if you look at closely, what we can see is very simple. In substance, what you have is a tax on the income of these particular digital platforms who do not have any physical presence in the various jurisdictions they are operating in. I've given 3 examples, like if, again, the statute itself specifically says, section 165A, that if you are paying a tax according to your permanent establishment, whether you're fixed place PE or service PE, you don't pay equalization tax. But if you are paying, again, section 1050 of the Income Tax Act specifically exempts companies who are paying equalization levy tax from not paying income tax. Therefore, again, a question always comes, what happens is substance versus form. I mean, if you even look at the Vodafone, it was again a question of your substance versus form. Generally, what we have seen is it is the SSCs who kind of put the transaction or the characterization of a particular transaction in a particular form, and they say this is the form we have and this is how it has to be taxed. But it is the revenue which generally goes and says, no, your form is incorrect. We look at the substance of the transaction. What does the substance basically say? Now, this is a different kind of litigation where the government has resorted to kind of saying that this is a form and our form is a transactional levy. But if you look at the substance, it again comes to see that this particular amount has been taken to levy or tax the income of these particular organizations, or the digital platforms do not have they do not have any physical presence in the various jurisdictions. Now, if you look at Vodafone, what happened? The form was one particular share was kind of sold in the Cayman Islands. Therefore, the SSC says, look at my form. I am transferring only one share in the Cayman Islands. Therefore, I don't pay any tax in India. Nothing in India has really happened. But if you look at what the argument of the revenue was, look at the substance of your transaction. What is the substance of the transaction? What happened when one particular share was transferred in Cayman Island? Your assets, the underlying assets got transferred in India, and the value of your total transaction that you got was because of the underlying assets in India. Therefore, in substance, what happened? In substance, there was a transfer of assets in India, and therefore you need to pay capital gains tax. That is one. So equalization levy, I mean, if it is challenged in court, it is going to be one of the big matters to see as to whether it is substance which the government generally have been arguing all along, whether it's a form that you have which will take precedence or substance that you will take precedence. The second matter, which again is pending in Supreme Court and which the digital companies would have a great interest in, is your withholding tax. Now, there are various companies who make software, and these particular softwares could be even wraparound softwares, customized softwares. Now, the question is whether when these softwares downloaded in your computer, made copies and sold, and at times are given only a license, whether it is a simpliciter sale or it could be a right being given to make copies. The basic phrase which is in contention is right to use. What does right to use mean in accordance with your treaty, and what is right to use according to your domestic law? Now the issue basically is whether if the right to use means that it is only a right being given a sale, then you don't have any withholding tax. But if your customization of your software, it is being given a license, and if it's not a sales simpliciter, then what you are being given a copyright you can replicate, then you have a withholding tax. The third important matter, which again is pending in Supreme Court, is market intangibles. That is the issue of your bright line or the white line concept, which was brought about. The Delhi High Court passed an order against the department specifying that the Income Tax Act doesn't have this concept of bright line or the white line. This was a case where the advertisement expenses which were incurred by the subsidiary companies in India, whether they will get a deduction of the whole amount or whether any amount could be allocated to their parent companies also. And the other important matter, which is again pending in Supreme Court, is your Sanofi matter, where Sanofi matter is similar to a Vodafone matter, where again shares were transferred abroad and the underlying assets got transferred in India. Therefore, these are the 3-4 important matters that comes to my mind, which litigation is likely to be watched by people all over the world who have your business interests in India, whether it's so far as transactional levy is concerned, where the digital platforms are concerned, and then you have the IBM matter, where withholding tax for your computer software, whether it's going to be any withholding tax to be done, or where you have your marketing intangibles, the advertisement cost is going to be determined whether you will get a deduction for the whole amount or only allocation would have to be done so far as your foreign holding companies are concerned, and fourth is Sanofi Pasteur, which again is similar to Vodafone, where again the question of form versus substance comes into play. So far as your equalization levy is concerned, it's going to be very interesting to see whether the government, who generally talks about let's look at the substance of your transaction is concerned. Now the government says, let us only look at the form of the equalization levy, which even though it has been said to be a transaction tax, actually is trying to tax these digital platforms. And its correlation with section 1050 and your permanent establishments looks like that this particular levy is more of a income tax, and therefore it is subjected to your treaties. And the last and the foremost important issue that again could be kind of interest to people is whether GAR overrides treaty. That is again something which is of a lot of interest in international tax. So let's see how the courts rule, and it's be of immense interest to all of us. Thank you.
Thank you, Mr. Prasad. It was wonderful, and you rightly said that ultimately it's going to be the doctrine of substance, over form. So naturally, that is going to be the key denominator which will decide most of this contentious issue. But of course, as Mr. Akhilesh Ranjan rightly also suggested that the allocation of taxing rights, etc., which has been talked about, and a new ground rules have to be laid down again, in international taxation domain, and so far as India is concerned. Naturally, in the substance, I'm sure the judiciary will be able to see a lot of substance in India as a stand where huge number of this technology companies and etc. They are generating income. They have the customer base in India, but they are not paying taxes. So that is where the revenue concern is. So let's find out. Let's go to some low tax jurisdiction. Which will give us more idea about investment and other things. So let me go to Genia, who is going to talk about what is happening and how Cyprus takes a look at the investment scenario from Cyprus angle and EU angle, of course. So over to Genia. Yeah, you can hear us.
Genia, you are on mute.
Yeah.
So,
over to you.
hi.
Yeah.
Okay. Thank you for this opportunity, and I hope you find the insights to this presentation useful and to meet your expectations. First of all, since this is a discussion with my fellow colleagues from India, I would like to briefly mention about Cyprus and India relations. Historically, India and Cyprus share a long friendship that is based on common sets of values and shared history of colonialism. The revised Cyprus-India double tax treaty, which was ratified in 2016, has vastly improved the business relationships between the countries. This new and improved double tax treaty is the result of a prolonged negotiations to address Cyprus' status as a notified jurisdictional area by the Indian government. The uncertainties brought about by this status have been eliminated, making it possible for both countries to engage in regular business transactions, greater transparency, and a strong impetus for investments in the field of agriculture, tourism, education, financial services, energy, information technology, and infrastructures. Okay, now to our subject about the big bad COVID, as I call it. We know that this event has led to a standstill of the world's economy. Countries throughout the globe have been in lockdown, many for several months, shutting down the entire economic sectors to control the pandemic's advancement. COVID-19 economic impact, as the other panelists discussed, will be enormous and will be felt for a while. Europe and Cyprus have started to address measures with priority. First of all, the first priority of measures were to limit the spread of the virus, ensure the provision of medical equipment, promote research for treatments and vaccines, supporting jobs and business in the economy. Cyprus government has taken early and effective measures to curtail the pandemic, but I must say the remarkable response also of the Cyprus citizens assisted a lot in controlling the situation. I'll tell you some stats from recent, the 2nd of June. The total number of cases of reported of COVID in Cyprus were 949. recovered cases 790, deaths 17, and tests carried out to 1 million population were 97,300. I'm sure the size is much less than Europe, but I'm just speaking from our perspective. So starting on March 27, just a couple of weeks following the detection of the first COVID-19 case, Cyprus established a series of measures to help families and firms weather the storm. These measures included extending timelines, filing of tax returns, deferral of VAT payments, for the company registrar to loosen the requirements in terms of payment and submissions. The Cyprus Exchange Commission extended the deadlines for submission of reports in coordination with ESMA and other regulators. Regarding the ongoing eviction process up until May, for borrowers facing economic hardship due to the COVID, the government also suspended their obligations to pay installments, both capital and interest, for their credit facilities, as long as the credit facilities were not in arrears. They have also given subsidy schemes. The welfare social insurance established a series of subsidies to help individuals and companies deal with the complete and partial suspension of businesses, sick leave, self-employment, childcare purpose, and etc. And special arrangements were made to move a lot of processes online. And government officials were given also ahead to host meetings via teleconferencing, video conferencing, in order to continue the economy flowing. So moving forward, as from 4th of May, we started relaxing these measures and restrictions, and gradually now the economy. As of 9th of June, the airports will gradually open to different countries, and very soon, connectivity with countries of Middle East will be re-established. The objective is to leave the COVID behind us and open up our economy and welcome international businesses and investors. So the Cyprus government on May 27 has also announced a series of other measures following the footsteps of Europe. And these measures were to strengthen the economy in the long run, encourage investment, innovation, boost liquidity through the economy, and provide support to small, medium enterprises and the tourism, agriculture, and real estate. So a number of packages have been announced to improve the liquidity. Some of the measures were mentioning of significant interest rate subsidies on loans for businesses and housing, grants and other kinds of financial assistance to help the business cope in the long run and address the corporate liquidity. Other efforts as well to improve innovation. More grant has been given to the Cyprus Entrepreneurship Fund, an additional 800 million for companies that want to benefit from this available growth and strategies. In an effort, furthermore, to accelerate the development projects, the construction and development sector, the government will speed up calls for trends for ongoing development projects. The aim is to boost employment and consumer spending. And for tourism as well, the Cypriot government relies a lot. They will invest significant funds on promotional campaigns showcasing Cyprus as a safe destination. Also, subsidies will be given for airlines flying in and out of the country. Also, for hotels and restaurants, will benefit a 4% reduction in VAT up until January 2021. Also, the government will support the agricultural sector via 22 million in grants. To conclude, as the whole thing about the COVID is that we have to think about it as a common experience, and then we can find the common ground necessary to work together to support a coordinated health response in search for a vaccine, but also to reopen our societies and rebuild our economies. Still, during the next several months, the immediate objective is to make sure the economy has sufficient liquidity and foster those measures required to jumpstart it. So speed and being proactive is the most crucial thing. Finally, COVID-19 has definitely created a paradigm shift. Plenty of opportunities are now available if business step out of their comfort zones and allow new ideas, and especially technology, which I believe will take the lead, to guide them during these unprecedented times. So that's in a nutshell, and then we can also discuss about the challenges in taxation, which, as the previous speaker said, the pressure because of the COVID is for governments to look for additional funds for the COVID. A lot of governments have taken initiatives of their own, such as the French government, for example, imposed a 3% tax on double digital taxation, the revenues of 30 companies, 17 of which were American. So a lot of countries are taking measures, but I think a holistic approach has to be found. So this situation is solved. But the main thing is about substance and look at, I mean, all the multinationals have to make sure that they follow these rules. Thank you for now.
Thank you, Genia. Thank you for making it a very comprehensive and a wonderful observation about what is to be found. And you are being very neutral that, you know, the governments need revenue and a way has to be found, you know, for both and also for the multinationals. Yes, rightly said that, you know, some common ground has to be found, you know, for both, for the tax administration, the tax jurisdiction, as well as the MNCs. So we will switch over to go to the next speaker. We have Mr. Sakar. Mr. Sakar is there, who has worked with several global firms before setting up his own. And he is a man known for his very strong personal opinion and observation about this post-COVID scenario. So over to Amit. Amitji, are you around?
Yeah, I'm there. Thank you so much. And hello, everybody, my respected panelists, and of course, everybody listening into this fairly interesting webinar. I would like to actually touch upon what's happening in the global international trade and how COVID has disrupted or created new supply chains and opportunities. And as a backdrop, I would like to start off by speaking about what was happening with India vis-a-vis the world just before we were entering into COVID. As most of you on the call would be aware, India had just 4 or 5 months before entering into a COVID situation decided to actually remove itself from discussions on the RCEP regional treaty, which was basically supposed to be a counterweight to the Transatlantic Pact, which was obviously originated through the US. It was hoped before India took this fateful decision that with the RCEP coming into play, India, China, ASEAN, Japan, Australia, New Zealand, and other such large economies would actually come together and have probably the world's largest economic bloc getting created. And with customs union and free flow of goods and services, it would also hopefully improve regional trade inside the Asian region. Essentially, the plan was to basically catapult all large Asian economies into the high table of global trade and to be able to dictate terms on the historical trade majors, which are obviously the US, the European Union, UK, and places like that. India took a brave decision, and the verdict is still out on whether that decision was correct or not, to walk out of the RCEP discussions, chiefly on account of India's concerns with regard to flooding of its domestic markets by cheap imports, predominantly coming from China. India was also concerned about how RCEP will look at its own domestic economy in terms of having a higher proportion of small and medium entrepreneurs, and correspondingly, most of the major economies in RCEP, for example, China, ASEAN, etc., would have a larger proportion of bigger companies that would actually compete with these SME groups. India also had concerns that while India was expected to open up its domestic market to regional trade, China was not forthcoming in providing such reciprocal access to their own domestic market, which is also, of course, fairly large. So all of these were the reasons why, of course, India moved out of RCEP. India, at the same time, had started already getting into discussions with the US, and we saw the US president coming to India just before the lockdown happened. And there were tall promises of a US-India trade pact getting signed. Of course, the US had removed the GSP status with India, which caused its own friction. India, in turn, tried to mollify concerns by reducing import duties on motorcycles so that the president's concern about Harley-Davidson actually can get addressed. India also, in the middle of COVID, despite having a fairly large population to take care of, promised to help the US by supplying HCQ, which was at that point in time at least considered to be a potential vaccine builder, which was obviously manufactured in large quantities in India because of our fight against malaria. So all of those things actually have led to a situation where India's traditional look east policy for building regional cooperation and trade has actually moved more towards India now getting closer and closer with the US. India now looking at having discussions with UK, which has recently come out of the European Union, and bolster its traditional partnerships with these large economies. India is also getting closer and closer to the Middle East. And the fact that Saudi Arabia, UAE, and other such large economies in the Middle East are coming closer to a page can be taken from the way in which the Middle Eastern economies and the traditional Islamic, political tinge that they have been cooperating with India in the international, platforms like the UN. In this backdrop, and considering COVID, now what really is happening on the ground? Had COVID not happened, we would be expecting any time a new foreign trade policy to be announced by India, and it is due. We were expecting India to have given a proper rebuttal to the fact that India lost the case in the World Trade Organization with regard to its signature merchandise exports and service exports from India scheme, or the MEIS-SEIS scheme, which was fairly popular amongst the exporters. India, of course, has provided an alternative, which is the remission of duties and taxes for export produce scheme, but that is not yet notified. That is supposed to be brought in a phased manner as MEIS and SEIS schemes get phased out. India has also, as a support to exporters during COVID, and as part of its 20 lakh crore economic package, allocated some 50,000 odd crores to be given as credit incentives for exporters for the purpose of augmenting trade. While all this is happening, there were also some very quiet announcements that happened in the period from later half of 2018 all the way till 2020. And I would want to probably bring that out, which can be of some discussion in this forum in the current context. We are all aware that India did introduce a more comprehensive authorized economic operator scheme. This scheme was supposed to aid in import and export facilitation. This was supposed to help in removing lead times for items getting imported into the country, give the commitment that there are secure supply chains in which people can perform imports of items in a more trade-friendly manner with the customs authorities. The AEO scheme now probably takes more importance because, as we're all aware, if and when the economy opens up, there will be a tidal wave of imported items that is likely to enter India, despite India's promise to be more self-reliant. When these imported items come into India, there is likely to be blockages in the ports. And it is important for importers of these products to consider converting their status into AEO so that they can take advantage of having a dedicated AEO corridor through which, in a secured manner, they can bring in their products and hopefully save on lead time. The AEO status also helps because since you have been verified and vetted by the customs authorities on supply chains, maybe you may not be required to ensure that the quality of the imports coming in, whether whether the coronavirus threat actually comes into through the import of these goods and things like that, those questions can also hopefully get addressed. India had also, in October of 2019, just a quarter before, just 90 days before we entered into COVID, revamped the customs bonded manufacturing regulations, which was creating a far more conducive atmosphere for a person who has a business model where he caters to the domestic market as well as the export market, where he can actually import items duty-free, and the customs duties, which form a part of the raw materials used for domestic sales, can be paid and only at the time when the goods are removed for local consumption. And there is no need to pay customs duties at all if the goods which are manufactured are actually sent back abroad. These kind of measures, which have got announced by the government, now take greater importance considering the cash flow impact that people are facing in the world of COVID. However, one area where the government has not yet provided any specific guidance is obviously how India is looking at rebuilding itself to be taking a more central role in global supply chains. There's a lot of talk that's going around of India hopefully replacing China as a manufacturing hub. But going by what conversations have happened, at least which is available in the public domain, there seems to be a lot of journey that needs to be covered by the government as well in terms of providing those kind of conducive policies to encourage people who have already set up manufacturing in China to consider India as an alternative. If not as an alternative, at least as a business continuity kind of an option. Lastly, we also have to keep an eye on how India will now react to the changed global order after COVID. The fact remains that just like India has stood up and said that we should be more self-reliant, this same principle is echoed across the world. America says the same thing. UK says the same thing. Most of the larger consumption economies are also saying the very same thing that India is saying. Buy local, resist buying global. Now, in this environment, should India also consider looking inwards to see how they can actually augment whatever items they want to import, maybe turn India into a larger assembly hub for some of the, white goods like mobile phones, electronic items kind of activities, which people are going to have consistent consumption demand in this country. So those were my loud thoughts in terms of what's happening in COVID with India as a center looking around across the world. Over to you, Sharanji.
Oh, thank you, Major, for making it very, very comprehensive and actually covering a very large spectrum of issues, including RCEP and Indo-US Trade Pact, and the post-COVID the scenario, how the global trade scenario itself will go away, and then India is resolved to go for Atmanirbhar scheme, and also at the same time be a part of the global supply chain. So these are the challenges will always remain, and I'm pretty sure that India, rather, if we look at the global geopolitical canvas undergoing a transformation now, whether, looking at Indo-US trade already in doldrums now, the China-US trade and its implication on the global trade. And also the fact that whether India actually did it well by avoiding not joining this RCEP, or you should reconsider joining it, the post-COVID. These are the questions, these are the political questions perhaps, which will come up later. And we will have to take a call before, of course, we get deeper into all these aspects and several questions which we have received on these issues. Let me go to, since we talked about Middle East, let me go to Mayank, who is Dubai based, and a lot of development, a lot of interesting policy decisions have been taken off late, including the VAT, the increase, which was not the case. Rather, post-COVID, the Saudi Arabia is one country which has hiked the VAT from 5% to 15%, and also in international taxation domain, particularly related to PE, etc., some changes have come. So over to Mayank, maybe who could give us some comprehensive view.
Thank you, Shailendraji. Hi, everyone, my fellow panelists and all the audience out here. I would give you an overall perspective of the changes which have happened in the GCC countries, and in particular in UAE. Historically, UAE has been one of the major global tech structuring hub for companies from India, Europe, and other countries, because of a very specific reason that unlike other tax-free jurisdictions, UAE is not traditionally a tax haven. But by decree of the law over here, the corporate income tax rate for most industries has been kept at 0%, with the exception of foreign oil and gas companies and foreign banks, which are subject to corporate income tax. All other industries are by and large subject to 0% corporate income tax rate. That has facilitated UAE in negotiating a better double taxation avoidance agreement with most of the countries in the world in the past. And for that reason, UAE has historically been a hub of being a holding company for a number of global corporations as it is, and has been used effectively as a legitimate tax planning vehicle. Now, in 2019, on 30th of April 2019, one of the major developments which has happened is UAE had introduced economic substance regulations effective for the financial years commencing from 1st January 2019 onwards. Now, these are in line with Action Point 5 of the BEPS framework, and it was obligatory on UAE and other tax-free jurisdictions to apply the economic substance regulations in their respective countries in order to comply with the BEPS requirement and to come out of the blacklist which the European Union had put them into from a non-cooperative tax jurisdiction. Resulting that, the first year of implementation, which is started now, so we are having the first year of filing ESR notifications and ESR returns for all companies in UAE for the financial year ending 31st December 2019. We are, that's the process which has started. And once the companies have started evaluating their positions in relation to that, a number of challenges have come across to comply with the ESR requirements, because the ESR requirements in essence require the companies to have enough presence of infrastructure and resources commensurate with the nature of their business. Most of the companies were operating their business in terms of the cost benefit analysis. Their resources or infrastructure were based in low tax or in low cost jurisdictions like India or China or Egypt or Turkey. But for the tax benefits, the companies were routing their billing from UAE. Now that whole structure needs to be relooked into, because you cannot use any of these jurisdictions, UAE, BVI, Cayman Island, purely as a billing or invoice routing mechanism. If you want to do a proper legitimate tax planning, it is required that you should have the actual economic substance effectively, which is happening in UAE. So you should have enough infrastructure, you should have enough decision making, which should be happening in UAE, you should have enough manpower and the resources which should be there. So that leads us to having a proper cost benefit analysis of what is the cost for a multinational corporation on shifting some of the resources down to UAE from the low cost countries like India or China, and still be beneficial on the tax front. So depending on case to case, the appropriate amount of resources and the infrastructure is being moved by the multinational corporations into UAE. And UAE has a unique position as compared to other jurisdictions like BVI or Cayman Island in respect of that. So we're seeing a lot of companies from other tax-free jurisdictions from Caribbean, from BVI or Cayman Island re-domiciling into UAE. We are getting at least number of requests every day for re-domiciliation. Now, what is the reason for that? The reason for that is in UAE, it is a proper operating economy where you can justify an economic substance of your business. Whereas in a typical Caribbean island or a BVI or a Cayman Island, you cannot justify the economic substance because most of those companies are operated by law offices and their shell companies. So you really don't have the economic scale to have an economic presence. Whereas in UAE, you do have economic scale to justify an economic presence. You can still do business in UAE with the additional cost you're incurring. So UAE or the Gulf can be an additional market for you. So rather than purely looking at it as only a tax vehicle, you can start looking at UAE as a effective operating vehicle as well for your businesses. And that's what a lot of companies or multinational companies who historically had looked UAE only as a tax operating vehicle are using it from an effective business perspective. And that justifies the additional cost they are putting in, in order to ensure the tax planning is legitimate and it is not questioned out from that perspective. Similar thing has come out in Bahrain as well. So Bahrain also was a tax-free jurisdiction within the Gulf countries. They have also introduced economic substance regulations. And for financial services industry, Bahrain, due to the proximity with Saudi Arabia, in terms of raising investors from Saudi and other Gulf countries. A lot of funds were set out of Bahrain. And now, instead of just having a shell funds, they're having proper operating funds where the decision making in relating to investments is happening effectively from those jurisdictions. So that has led to a major transformation. Whatsoever tax planning structures the multinational companies from any part of the world historically had, they all need to have it, revisit it basically. But having said that, it is not that, the tax planning or tax structuring in a legitimate way is not possible. As long as we comply with the principles, we can still do a global effective tax planning in a legitimate way without the questions being raised. Coming down to the second part of the developments which have happened is around the overall thrust for revenue of the Gulf countries from the taxation. Gulf countries historically have by and large been tax-free, with the exception of Saudi Arabia, Qatar, and Oman, which had corporate income tax to, which was taxable, or zakat on which the companies in those countries used to pay. But there was no form of indirect taxation which was ever levied in these countries. So now, from 1st of January 2018, UAE and Saudi Arabia introduced VAT, and on 1st of January 2019, Bahrain also joined them and they introduced the VAT. So we have 3 Gulf countries which have got the VAT. Now, the VAT in GCC was introduced as part of the common GCC treaty, as per which the Gulf countries had to, agree, like similar to in the European Union, that whatsoever decision in terms of effective rate of VAT and other major factors in relation to implementation of VAT, they have to be common across GCC. So it does not become competitive advantage for one country vis-a-vis another. So what was agreed in the GCC treaty as a normal course of business, that any increase in the levy of the VAT rates or any other major changes will be happening in, connivance with all the GCC countries together. However, in a surprise move last month, Saudi Arabia had announced on a unilateral basis with, as using an exception of COVID-19 as extraordinary circumstance or force majeure, which allows them to take that unilateral decision for their own economy or on their own fiscal revenues, they have increased the VAT rate 3 times straight away, from 5% to 15%. This is one of the most unprecedented increase in percentage terms any jurisdiction has increased in the tax rates, or in terms of the 3 times increase in one single step. It has been unprecedented. But given that the oil revenues, which Saudi Arabia and other Gulf countries are dependent on, due to the reduction in the oil prices and overall oil demand due to the shutdown and the lockdown across the world, this was the need of the hour for them to sustain their fiscal revenues or the government revenues, because their dependency on oil over the last few months, the overall production of oil has gone down, the demand has gone down, the prices have gone down. So they had a major hit in terms of revenues. So this was kind of the measure they had to resort to. Effective date of increasing this rate is from 1st of July 2020, but they have introduced a transitional provision, at least on the B2B contracts or business to government contracts, that if you have existing contracts which have been agreed at a 5% VAT rate, they will be still continuing till the time of expiry of that contract or till 30th of June 2021. Still 5% VAT will be applicable, given that it's a revenue neutral position, since the recipient will be able to recover the input VAT. But at least from a cash flow perspective, that has been a major relief for a businesses, that they don't have to shell out, at least on the existing contracts in terms of the cash flow management. They don't have to increase the additional levy. Subsequently, Saudi has also increased their custom duty rate on most of the basic necessity products which Saudi was importing out, including some fruit, vegetables, and dairy products, etc. as well. Now, a reason for this custom duty increase which Saudi Arabia has done is primarily a focus of the Gulf countries to save petrodollars within their, or to reduce the outflow of petrodollars, the money which they're earning from fuel revenue, to be going outside the country. As much focus like all other countries are doing on looking inward, and as much production or the value addition can be done within the country. That is the focus of the Gulf countries. In UAE, you have the biggest oil and gas player, ADNOC, which requires every supplier which is supplying to them has to get an in-country value certification report, and the suppliers which have a higher in-country value percentages, that is how much value addition you have done within UAE, they get the preference in the their oil and gas tenders. Similar emphasis is on Aramco in Saudi and other Saudi entities as well. In order to save the petrodollars, they are also focusing on looking as much production or manufacturing can be done within the country, so that there is not more outflow of the petrodollars going out from these countries, because these countries are reliant on imports to a huge extent. But they are also slowly realizing that they cannot sustain on oil revenue for a very long period. They need to diversify the economies. So there is a lot of thrust on manufacturing, and the custom duty increase, which Saudi has recently, put on a number of items for import into Saudi. That is a result of that focus of saving the petrodollars. On the other fronts, we also have excise and customs, which we have seen major changes happening in these jurisdictions. Now, excise tax, which started with a few specific items, and which is a very high rate of excise tax in this part of the world, 50% to 100% is excise tax levy on tobacco, on cigarettes, energy drinks, carbonated drinks, and now that scope has been expanded into sweetened drinks, which includes any kind of sweetened juices and other form of sweetener products, including electronic smoking devices. So slowly, what we have seen the thrust is the GCC countries, UAE, Bahrain, Saudi, they're all putting additional taxes. They're getting revenue from those. Again, the justification for levying such high rate of these taxes, these products are generally harmful for health practices, so they are wanting to reduce the consumption of these products, and by put a higher rate of taxation like all other countries do. They may be successful to some extent in reducing the consumption of these products. But we have seen a major transformation over the last few years from a pure tax-free environment on slowly moving into a more regulated economy. The tax rates as compared to the rest of the world, both on the corporate income tax side, the 3 countries where the corporate income tax rate is there, as well as on the indirect tax side. By and large, we have 5% in UAE and Bahrain, and they've announced that they will not follow the footsteps of Saudi because their countries' dynamics are different. Bahrain and UAE are dependent on the expat population by and large. So with the increase in the VAT rate by that level, it will lead to the exodus or outflow of the expats from this country if the cost of living becomes too high for them. And these countries cannot afford to lose expats, because the expats are the ones who are driving your retail demand, who are driving your real estate demand. So the dynamics given, in UAE and Bahrain are different in Saudi. So we do not expect UAE and Saudi will follow the footsteps of Saudi in increasing the VAT rates. In fact, the Ministry of Finance in UAE has, after the Saudi rate increase, has officially came up with a statement that they will not be increasing the VAT rates. However, correspondingly, on the background, the Ministry of Finance in UAE is also working in introducing corporate income tax rate on the mainland companies in a few years' time. So the Expo 2020, which was supposed to be organized in Dubai this year, it has been postponed to October 2021 to March 2022. So we do expect that post organization of Expo, they may announce the introduction of the corporate income tax rate on the mainland companies. The free zone companies, since they come with a 50-year tax holiday as a part of the commitment, will be still kept outside the corporate income tax rate by legislation. But the mainland companies which are not operating in the free zones may like to, will likely be subject to corporate income tax rate. It might be a low rate of around 10%, but we have to wait and see for how the developments go. But there's already a background work which has started from the Ministry of Finance on that side. Maybe in 2 to 3 years, we will see the corporate income tax rate in that part of the world. And that also gives rise to a number of multinational corporations as well as UAE-based companies to start looking at their corporate tax structuring right from the word go. So a potential of moving your holding company or your head office from a mainland in UAE to a free zone can be explored at this stage, because once the tax announcement is made, it will take if you do the changes at that point of time, it will take the shape of a tax evasion. And as we know, there's a very thin line between a tax evasion and tax planning. But anything which is done prior to the announcement of an actual corporate income tax rate in the country, and you change your corporate structure as a normal business practice, and then by the time the tax is introduced, you're already operating under that corporate structure, it can still take the shape of a tax planning, a legitimate tax planning. So there are a lot of developments which are happening on the taxation front. and the COVID-19 scenario with, restriction of people who were actually, running their businesses, on a basis, they were, operating, their base was another country, they were coming on and off the UAE for their business. Now, due to the travel restrictions in place, the people have to change their business model. They might need to have, people effective, management in the respective countries, because the travel restrictions are not going off for a certain period of time, in order to ensure that, that the businesses are run smoothly. That whole way the world was working, you can actually be based in one country and keep on running your business in multiple countries, because the travel was quite easy. Now that whole thing has to be relooked into. So wheresoever you're running your businesses, especially in this part of the world, you might need to have, from economic substance regulation, as well as from your business needs perspective, now need to have your own management team who's running those businesses, or you have your own employees or resources, of course, subject to doing the proper cost benefit analysis. And that would be something which I believe all the companies from India who have presence here, or companies from Europe or other countries, would need to start looking into. So that's, what I would say, a bit of overview on the GCC countries from my side. Thank you. Over to you.
Thank you, man. Thank you for a wonderful overview, and you have actually you have indicated, to the good number of participants, how the ground rules of taxation being reconstructed and rewritten in the GCC countries, and they are actually, as the global trend indicates, that every tax jurisdiction is moving in the direction of significant economic presence. That is where your economic substance theory, comes into play. And of course the customs side, and they have it looks like, the Saudi Arabia has borrowed this concept of central excise, high central excise tax rate from India, and they're levying such a high tax rate. Maybe Sudipta would like to touch that point later, so let me quickly move to Sudipta before we have dozens of questions with us. We will take up all those questions. So Sudipta, maybe you would like to give us a very comprehensive overview, including the GST part, which is the only one which we have left so far. Of course, Mayank has talked about that international VAT, so we will talk about GST now. Yes, please, over to Sudipta.
Thank you, Shailendra, and hello to the panelists and the esteemed guests who are listening in. From a GST side, in India, so far the reliefs have predominantly centered around deferment of compliances to ease cash flows. Returns, the typical GST returns have been allowed to be postponed, in some cases with very limited or lower interest rates. So that helps with a bit of cash flows. Is that enough? I think the answer resoundingly is no from the industry. There have been demands of larger deferrals. Examples have been quoted from Australia and some of the European countries, where apparently 6-7 months of deferrals have been given. Demands have also been raised for a complete waiver for a 3 month period. Now, I don't know if that level of fiscal space exists with the government. As per the latest data that I read, there has been a 70% drop in the GST revenue of the central government in April 2020, if we go on a year-on-year basis. So with that kind of a drop, that kind of a hit, I mean, it's easy to say, let's not bother about fiscal deficit and let's print money and write this through. But that kind of deficit or that kind of a gap is very difficult to bridge. But what more can be done? What is it additionally that one can do? If you look at what the states have done, and even the central government for that matter, thankfully, I mean, the only sort of, I would not call it a silver lining, but the fact that could be taken advantage of was the low crude prices. So the state governments as well as the central government has hiked the taxation to bridge the lower crude prices, to bridge the gap in that, bridge the arbitrage, so to say, and shore up some amount of that fiscal deficit. In terms of suggestions that has come, I think one of the biggest and the most radical suggestion, if I may say that, is to allow businesses in service sector to pay GST on a cash basis instead of accrual basis as the process now. And this was of course not a very new idea. This was the norm under the service tax regime in before or up to April 2011. And if it is allowed, of course, it will be a massive cash flow optimization option for a lot of people, even if you're only doing it for the service sector. Second, and not as radical, but I think a very critical suggestion that ought to be looked at, is monetizing accumulated input credit. Now, this is a major issue. There are many companies which are sitting on massive accumulated input tax credit, maybe because of inverted duty structure, maybe because They have taken up projects in states and they have accumulated a lot of credit, and now they have no other output liability in that state. So in that state, say in Rajasthan, there is a lot of accumulation. They have output liability in Karnataka, but it cannot be used. So it's just lying there in Rajasthan. And what does one do? So in all these kind of scenarios, one needs to really think about how to monetize. Now, the easiest thing to monetize, or the easiest option to monetize, would be to ask for refund. But as I mentioned, I don't think the government is in a fiscal space where refund can be granted. So what are the other ways? Maybe one can relax the rules of usage a bit, allow it to be used in another state uh, currently which is not allowed, or like we have the concept of MEIS, SEIS scripts, maybe in some manner or form the ITC, accumulated ITC in one state, can be converted into scripts which can be freely tradable, of course at a discount. So if there is 100 rupees of credit, maybe we can talk about allowing 80 rupees worth of scripts to be monetized out of that, and that can be sold. Anything, because see, ultimately I think there are a bunch of high court decisions which have come in which say that ITC, accumulated ITC, is property of the SSCs. It's a vested right. And if it is a property, I think it's of utmost importance that we allow it to be monetized. I think this is a very critical suggestion. Other suggestions range, I mean, in the usual thing is, let's have rate cuts. Now, I think across the spectrum, rate cuts are A, not feasible, B, may not even be desirable from a GST design perspective, but there definitely needs to be some emphasis, one needs to look at some of the sectors that have been really badly hit, whether it's tourism, hotels, restaurants, aviation. I mean, let's pick up aviation. Aviation turbine fuel has been outside GST, and every year we hear that there is some bit of consensus. We are almost arrived at a consensus to include it in GST, and then again there are two steps back. So I think this COVID probably offers us the best possible chance in order to arrive at a consensus between states to include ATF into the purview of GST, because that will give a massive amount of cash flow optimization option, credit eligibility for airline companies, and probably save many of them from imminent bankruptcy. I don't need to tell you, I think all of us are aware how badly aviation is hit, how many people are losing their jobs who are connected to the aviation sector. So this may be a good time to look at aviation sector specific needs, and ATF, including ATF in GST, is probably a very good measure that one can look at. Tax on sin goods, I think Mayank mentioned how that is happening in the Middle East, and that's something that can probably be looked at here also, whether it's a tobacco, whether it's alcohol. In fact, many states have taken the cue vis-a-vis alcohol, and the rates have really been pushed up, whether by calling it a COVID cess or a COVID fee, or by calling it an additional tax on VAT, because as you are aware, on alcohol there is no GST. So typically state sales tax or VAT gets levied, and many states have levied 20, 25, 30% additional tax. Unfortunately, some states have gone ahead and like Delhi, the state government of Delhi levied a 70% corona fee, which full disclosure, my team has challenged it in Delhi High Court, because while hiking the rates, one has to stay in the realm of reasonableness. The problem with sin goods of this nature is, if you push up the taxation too high, you are essentially encouraging the underground. You are essentially encouraging people to drink spurious alcohol. You are essentially encouraging bootlegging and smuggling of alcohol from neighboring states. So there has to be a concept of proportionality when we hike goods, when we hike tax on even something like sin goods. So that is one measure, of course, that states will surely look at. And as a fallout of this, I think as a non-tax measure, probably, online delivery of alcohol is something that ecosystem will get created. I mean, we will probably have the likes of Amazon moving into or Flipkart moving into alcohol delivery. It's a high margin game, and the ecosystem probably might get set up now because the states are really chafing at not getting their share of GST on a timely basis from center, and they do need some bit of fiscal autonomy to have fiscal federalism. Couple of brass tacks point. I think there has been a lot of discussion about availability of input credit, eligibility of input credit for expenses, for COVID-related expenses, whether it's medical insurances that companies take covering COVID, whether expenses incurred for deep cleaning, fumigation of office premises, thermal scanning, face masks, the whole 9 yards. I think whether or not credit is available on some of the items, there is a question mark, and I think this is the least that we can expect from the government, that this aspect be clarified. Even if some of these expenses are physically being consumed personally by employees, this is a health and safety expense, and there should be no doubt that credit should be available. This aspect ought to be clarified so that at least on this minor point, there is no litigation. And from an attitude perspective, I think one of the questions that got raised on the sidelines of the chat the beginning of the call is, why is the government so proactive in undertaking a retrospective amendment to undo some of the favorable high court rulings that have come in the context of transition credit? I would go one step up. I would say this needs I think there is a need for an attitudinal shift. There is a need to, government needs to really stop fighting this battle. We are completing 3 years of GST next month. We should not be still fighting on transitional credit. And COVID-19 probably offers the government, offers the stakeholders the best possible honorable exit route. The government should accept the favorable judgments and issue a circular, issue some sort of a notification or a removal of difficulty order, agree that anyone who has missed out on transitioning credit by 30th June, file your claim and be done with it once and for all. I think this is one battle that definitely does not need to be won by the government. And while some of the more radical suggestions cannot be accepted by the government due to lack of fiscal space, I think this is something that can be done and that would be a lot of benefit or bring in a lot of benefit for a lot of people. I think these are my opening comments, Shailendra.
Thank you, Siddhartha. Thank you for making it very comprehensive and very balanced in terms of revenue requirements for most of the states as well as the center, and the need to monetize the ITC, which is either accumulated or in whatever format. And like you said, the COVID-related expenses that corporate entity has to incur, and of course, Mr. Sridhar will certainly add more point to it. And you rightly say that it's time for most of the states, perhaps they have got intoxicated and they are levying corona cess and surcharges, etc., because they need to garner some revenue either to cope up with this sudden hike in the government expenditure to meet the corona related expenses in terms of setting up new hospitals and testing, etc. Yes, it's a tough time for all of us, for the government, for the tax administration, for the taxpayers as well, and we have to find some innovative solutions, and some of them of course rightly came from you. And of course, let's hope that the next GST Council meeting, which is going to happen anytime before 14th of June, because as per the GST, the conduct of business rules, they have to meet once in a quarter, and last meeting was on 14th. So I am hoping that before 14th the GST Council will meet, and certainly they are going to take into account most of the suggestions which are reaching the GST Secretariat, and they will certainly take a fresh look at it. Yes, Mr. Siddha, you like to add something? Yes.
Yeah, a few questions to Sarkar also, who had pointed out on this WTO's two orders that have gone against India. I just wanted to point out that first. It came out in the fiscal press that the India has filed an appeal somewhere in November and somewhere in the first week of December. Now, in view of the COVID, was this appellate mechanism not taken up in view of COVID, or where are we? That is the first thing, because I have not followed any press articles or even TIOL international updates on what happened to the appeal before the appellate mechanism, before World Trade Organization, on these issues of these two schemes being pulled up consequent to the US application and our appeal under Article 27. That is one. Second is that I wanted to raise the same second question dimension in terms of international trade that has come up. See, in 2020, India bought a separate chapter under the Customs Tariff Act, revamping the entire safeguard rules. Shailendra, we did a complete session in Tax India Online on this topic. Now, the point is, in view of the revamped safeguard duty and in view of the perhaps regenerated anti-dumping regimes we have in our country, is there any need for India to fear and not to enter any custom union arrangements or any agreements, so that that will be creating a problem? And the third observation for Sudipta is this, that it is not only monetization of credit which needs to be thought of. I think there is only one point which we would like to supplement to what Sudipta said, that the entire from 1st of July 2020, when the entire Indian economy opens up, it is a must, Shailendra, that this country should not argue anymore on the vested right of input tax credits. If we keep arguing in 2020 also on vested right of credits, then we will be creating another ModVat, SENVAT in GST, and the list of litigation that will go through. So finally, there has to be a clear baking start. Some fiscal measures were also bought, fiscal suggestions were also bought on TIOL updates, because you said the meeting will happen before 14 June. We talked a lot about protecting ITC on return of products, which became a major loss situation in these 3 months. I won't say 2.5, I would say 3.5. From February 15th onwards or March 1st onwards, there has been very minimal sales on many products. So the right of ITC protection also, as an addition to what Sudipta said. These are, in short, my comments. I don't want to take any further.
Okay, yeah, Mr. Amit would like to answer the question number 1. Then I would like to add a few points. Yes.
Sure. So, with regard to the appeal that India is proposing to file before the WTO against the WTO's order, where they have struck down India to carry on with the MEIS, SEIS schemes, I am in the same situation as you are, Sridharji, because information in terms of where exactly is that appeal, etc., whether we have been able to successfully file it, if we have filed it, what are the steps arising out of it, is something which at least I am not too aware of as of right now. However, I will take a page from an earlier case that India had in the WTO, which was in the context of the erstwhile focus product and focus market schemes. And even before that, with India's famous infamous DPP passbook scheme. We have unfortunately been quite sad in terms of defending these schemes in the global forums. And in the event that India does appeal against the MEIS, SEIS schemes, it is reasonable to expect that India's defense may not be entertained by the forum. Of course, I hope personally as an Indian that we do win the case. Having said that, the other question which you asked is probably more interesting. Okay, yes, India.
Before you answer the other question, let me add a small point for Mr. Sridhar, that WTO Appellate Forum apparently is in a sleep mode right now. I think you must be aware that WTO Appellate Forum, some of the appointments which had to be approved by the US, and US has been opposing it. As a reason, even if India has been successfully filing the appeal is not going to be heard. So as a result,
So if I may add in here, so the appeal did get filed. I think the deadline for the appeal filing was January this year. So sometime in December, India did file. Interestingly, it was a strategic move by India, because once you have filed an appeal, you don't need to implement an order that has gone against you.
Absolutely.
So on the last day, so the quorum was, I think you need 3 judges and only 3 were left. Right. And the third one was about to retire on 12th December. So India filed the appeal on 11th December. So as per the WTO treaty, till disposal of this appeal, India is pretty much free to do what they want to do. So I think I completely agree with Amit that I think in terms of the arguments, I don't think India is a very strong case. At least by reading the order, it would seem India does not have a very strong case on merits. But I think by this fortuitously, because of thanks to Mr. Trump's actions, we have at least 1.5 years leeway before we need to do anything from the. So we can actually introduce ROTTEP in place of MEIS fairly slowly, thanks to this set of events.
Yeah, absolutely correct, Sudipta. Let's go back to Amitji. Yeah, Amitji, you wanted to ask.
And thanks so much for clarifying that, Sudipta. In fact, that probably answers a lot of questions that people who are listening in may have had as to why India has not really brought in RODTEP and why is India surreptitiously pushing and pushing and pushing the MEIS, SEIS schemes very, very slowly. And that's something which everybody in the market is also fairly familiar with. But coming to the next question, and that's probably much more interesting because that's nebulous in its situation. And I have to thank Mr. Sridhar for highlighting this for all of us. Yes, India has brought in a framework to have a tactical safeguard duty net spread across its domestic economy. Yes, India is concerned that the kind of protections it was erstwhile entitled to, or which it could probably look forward to under the WTO, I believe India is finding itself in slightly thin ground. And the reason why, in my personal view, India finds itself in thin ground is because India is in a bit of a self-conflict mode. On the one side, as I was mentioning earlier, India wants to be self-reliant and wants to deny imports of finished goods to come into its country, essentially to make India an exploited market for overseas products. But on the other side, India also wants its fair share to be sitting in the high table of supply chains of the world. How do you ensure that you take care of this? You cannot go product by product. You certainly cannot go country by country because there are wider areas to be concerned about. On the one side, you invite the Chinese president to come over for a walk in the sands of Chennai. On the other side, you stand up and have a conflict with him in the icy summit of the Himalayas. You can just imagine the complexity of the situation. So it's a nebulous step. I would say it's an option that India is keeping, and we have to wait and watch what India would do. And like I said, we have to wait and watch also because there are other areas and other fronts in which India has started to negotiate, which negotiation is still also very raw. The India-UK negotiations, the India-US negotiations, the India coming closer to the Middle East, and also the untapped potential of India's service exports and how India can use that in a socio-economical or political leverage in its debate with the world.
Actually, one point which we had even earlier said in TIOL in our internal coverage was that this appears to be this really is implemented on the indirect side also. And if you keep on, because this would override that also to that extent, because it starts with a larger objective. So whether it is COVID or no COVID.
True. I think, Sudipta, you would want to take up his last question on GST.
I could not, his voice broke. Did you hear the question completely? I could not.
He had asked that initially. I think I didn't note down the question, but Mr. Sridhar, you could probably ask the question again.
On the input tax credit and on the loss of the inventory in the last 3.5 months. So correct. I think the input tax credit should be protected.
Yeah, this is a suggestion that went directly from TIOL also in our articles.
Absolutely, and I think that's a very reasonable ask. I mean, this is not something that will require a large fiscal, outlay, so to say, and this is not as radical as the suggestions of doing it on a cash basis or, completely waive GST for 2 months. Those are unlikely to happen. This, I think, is a lower hanging fruit and definitely can be done because one is, I think, the entire consumer facing business. Whether it's in the fashion side, whether it's in the packed food side. Like I was talking to someone in the fashion industry. So one thing I remember, Mr. Sridhar, you had once discussed that merchandise of Zara had caught fungus because it was lying in a shop for 3 months and without AC for a lot of time. But the other thing that can happen is also because fashion is so fickle, apparently in 6-7 months time, if the goods are not sold, they have to mark down by 20-25%. So I think losses is another, and this is also another aspect. So all the time-sensitive inventory, I think there is definitely a need to issue a removal of difficulty order or some sort of a amendment where the relevant provision under 17(5) dealing with denial of credit for loss of goods, I think that can be suspended or an exception be created. At least I think for a 6-7 month or maybe this fiscal, I think that is definitely a very, very good suggestion.
In fact, Mr. Sridhar, I'd like to add a couple of points here. As rightly suggested, although the ITC is the vested right of a taxpayer, but one reality we have to accept that as per the government's internal analysis, almost 85% of the tax liability on the outward supply is actually being paid through ITC. So what government of India or states are getting is only 15 paisa out of 1 rupee. And they have to run the government, they have to meet all the expenses. And that's the reason that we have a lot of artificial, the blockage of credit. If you look at those various sections where the credit has been blocked.
Absolutely.
So, that's the reason, that is why the government, but perhaps GST Council can take a little considerate view this time, in terms of write-off, etc. And so far as safeguard duty is concerned, if you look at the global trend, the protectionism wall is going up. And it has more to do with the politics, the domestic politics. Good number of the domestic sectors, they are putting pressure on Ministry of Industry and Commerce, and the government of India are coming under pressure. And the fact that our exports are not doing very well, right? So, government is under pressure to somehow protect, either resorting to safeguard measures, right, or anti-dumping duty measures, etc., to protect the domestic industry. So this tug of war will continue, for some time, till the time we are back on feet. The economy will take some time, a couple of years, of course, minimum. So now we have, most of the speakers have shared their thought and observations. And we have, before I go to reserve, maybe it's time to open the floor to some of the questions which we have. And we have many observations rather than the questions, which of course I would like to share with panelists, distinguished panelists here. Maybe you could add more to it. And now there is one question where some gentleman is talking about the consolidated corporate tax return is already in place in many countries. Why can't India follow, which can help Indian MNEs set off their loss making with profit making outside India? Yes. So somebody has talked about this consolidated corporate return, which of course, which was talked about initially by one of the panelists. So I think maybe these are the ways forward. Of course, we will have to adopt some of those measures which are being adopted worldwide and being put in place. India will certainly do that, but maybe in a phased manner, because again the revenue is a concern. For India, and the fact that as Sudipta initially suggested that ATF, so many times it has been discussed, etc. And this is a high time the ATF is brought under the GST purview. Perhaps that will be a relief for the aviation sector, which is already badly hurt. So maybe a lot of measures like this, consolidated corporate return, India will also do it in a phased manner, perhaps, because then again setting up profit you are making outside India, and you are setting up this here in India, the losses, etc. So again these are the questions which are basically largely from the realm of policy making, and the government of India will have to take a view on this. And maybe the post-COVID scenario, I don't see that all these reform measures the government of India is in a position to take. These are the radical and fundamental reforms which can be undertaken only when the things we are back on rail. Right now we are completely off the track. And most of the tax jurisdictions are off the track. So, every tax jurisdiction will try to get on the feet first, because if you look at the revenue, for instance, the tax administration, direct side, indirect tax side, both the sides, they're lying low. My only fear is that, they are accumulating a lot of energy, Once Mr. Sridhar says that the economy will be, operational again from 1st of July, and they come back into action, then you can expect a lot of notices, a lot of things. Assessment process has to start, the returns, etc. So so many other issues. Yes. So now do we have other observations here? Somebody is saying that yes. Okay. In fact, largely we have lots of observations. We have. Many inputs to agriculture are also being high GST, but due to exemptions to most of the products in value chain, the GST, there is a cost disadvantage to the sector. Can it be zero rated, etc.? So the ITC benefits can be passed on. Okay, so this is a question which perhaps Sudipta would like to touch. That somebody is talking about that APO. The APOs where we have this farmers, the organizations where a lot of inputs to agriculture which are attracting high GST rates, and in some cases the exemptions are there for certain products.
I'll explain this question. So basically, in farmer producer organization, most of the input like agriculture input equipment, tractor or cultivating machines, pesticide, fertilizers are taxed in the range of 12 to 18 and even higher rates. Now, because most of the product at the original level are exempted, so the credit chain get disrupted there. So if we want to build an economy which is rural driven, because yesterday also in the cabinet meeting, it was decided that India lies in rural. And we are seeing after COVID, a lot of migrant workers are going back to their roots from the cities to the rural. So if we have to create the rural enclaves and if we have to increase the income of the farmer, we have to go to the agri-business and agro industry. Now, the moment we talk about agro industry, why somebody will invest with the tax structure which is not intact, which is a broken? So that need to be fixed by zero rating the agriculture input, so that it attract the investment from the outside state as well as outside India. So that is the one point which I want to raise here.
So that question is for Sudipta, right?
So
now, sir, if you allow me, I would like to talk about the tax technology. I think that is the piece which we have not touched upon yet. So if you allow me, I will
do this after your question is answered by Sudipta. We will go to the tax technology part. Yes. Yes, Sudipta.
Right. So I think, Rishabh, I couldn't agree more. There is already a lot of movement towards facilitating agri-business. I think some of the laws have been lifted, some of the restrictions on interstate trade of agricultural products has been lifted. And as you rightly said, I think everyone has now identified the need to bolster rural economy, because if all the migrants who have gone back have to be gainfully employed, you will need, and agriculture is of course a labor intensive sector. So I think it makes sense. And to that extent, wherever there is a wherever there is a accumulation of the nature that you highlighted, I think a zero rating will definitely go a long way. In fact, if you see some of the representations that were made before the GST Council, or in the run-up to the GST Council meeting, for seeking a waiver from GST or an exemption from GST for 1 month or 2 months. This was the comeback from the government side, that if there is a exemption or a waiver, there will be a massive ITC accumulation. So it may not benefit the overall supply chain. I think the answer to that is, in many cases, not only vis-a-vis agriculture, but any other critical sector that we identified, zero rating definitely will be a better approach.
So
even the healthcare industry should also be zero rated, because it's a booming industry post COVID-19.
Absolutely.
So Sudipta, there is a question, here, that if GST payment on collection is to be allowed to services sector, then the corresponding ITC should also be allowed upon payment of GST only. So the ITC is going to be denied in that scenario.
So that's I don't think that. Yeah, I mean, I don't see a issue with that. See, I think the problem that arises is, if we are paying on accrual basis and I'm not getting paid, I think that's the bigger hit. I think credit is a subsequent thing. If my tax liability itself is getting postponed, I think that is a massive relief. And credit can, of course, follow the deposit of tax, which is the case today also. So to that extent, I don't see a problem with that. But I mean, to be honest, I think I don't foresee the move from accrual to cash basis. I think it's a good to talk about point. Sounds very radical and interesting. I doubt that this is going to be implemented.
Okay.
Already Rahul Kant has posted, Shailendra, that the 40th meeting of the GST Council is to be held on 12th June through video conferencing. I don't know whether you have noticed the chat, because you said 12th he has already.
In fact, this date, the two tentative dates were sent to the state from the GST Secretariat, 10th and 12th. So most probably it will happen. And in case it has to take place before 14th, yes. Okay, so now let me go to the technology man, who is going to talk about tax technology. Yes. So
thank you, Sridharji, and thank you TIOL team and all the panelists. See, all the members who are attending it. So COVID-19 gave us two new but permanent things which are impacting corporate decision making. One is work from home, and other one is expediting the automation and digital skill across the organization. So with cross-border supply chain and taxation scenario we discussed are changing faster than we think. It has become more need than a luxury to basically have a full-time technology resource in every tax, legal or finance team, helping the digital aspect of tax, transfer pricing, custom, VAT, GST, litigation planning, MIS, corporate audits, or even compliance. So what I would like to say is that what you cannot manage, what you cannot measure, and what you cannot measure, what you cannot describe. So that today the challenge with the standalone ERP system, be it Oracle, SAP, Tele, or even Microsoft, behind the firewall locked in the office and lack of fungibility of data and ability to put the data into a meaningful predictive sentiment analysis. This is the bigger challenge every tax in-house counsel as well as tax consultants are facing today, because the availability of data all of a sudden become a restrictive. So there is the use case of artificial intelligence and machine learning, which can work with both the external set of data and internal set of data to give you a predictive analytics. So predictive analytics means what? These tools are available, even they were available in the past for the operation, supply chain, production planning, etc. But now there is a bigger use case for them in the taxation, in the cross-border tax planning, also in managing the filing of the tax returns, because mostly the corporate tax returns get even 4i, 6i, 8i test, but your transactional tax return don't get that many of tests. So with the AI, use of AI, you can actually become more friendly towards the management to make a decision, and make a decision based on the changing data sets of the external environment as well as the internal environment and the or vendor side and customer side. So there is a bigger need for the data journey of data from monitoring, analysis, prediction, and prediction of the future. So as a professional, we are helping a lot of clients in AI and ML implementation at across the sector in compliance function. So that was my take, that AI is going to be the future for tax profession as well as the litigation. And recently we have seen when courts are also going digital, it's high time for all the function to break the silo and talk seamlessly. I think that's what my take on it. And I believe that, in all the four major environment, products are right now available by multiple providers in India as well as abroad.
Thank you, Rishabh. Thank you for making it very very brief and very precise and very effective. The tax technology, yes, it has a very bright future, very critical role to play for tax gatherer as well as taxpayers. So as you rightly said, the courts are also going virtual, and the taxpayers also adapting to this new environment. Of course, AI will have, certainly AI in any case, and machine learning will have a very a critical role to play in managing the tax liabilities, the data, the hearing, the litigation, everything, of course. So
just one example I would like to say that in India, 80% people are using Tele system. So there are tools available for AI as low as $5,000 per year, which can deploy along with Tele, and your Tele will become like any other world-class ERP with business intelligence.
Okay. So now we have one question, for Amitji, that how is this, the new scheme, the ROTTEP, is different from MEIS. I mean, the WTO panel report inferred MEIS as not related to the input tax. Given that the rate was different for different set of companies, it's been truly average, it would be fine. But given the political environment in India, are we sure that the rates wouldn't be differentiated between class of persons, so the rates would not be suddenly increase or decrease? Isn't it just a blanket over MEIS for that matter? I mean, somebody has read, it's a tinderbox,
So no, let's just understand fundamentally the change or the difference between a MEIS or SEIS scheme versus what the government is proposing, which is the revision of duties and taxes against export scheme. The fundamental difference is that under the MEIS or SEIS scheme, the government was free to arbitrarily put forward a percentage at percentage of value of exports against which the benefit can be given. For example, the government wants to bolster exports of textile products from India. So the government might say textiles exports would have maybe a 7% MEIS scheme benefit, and the government wants to probably not look at iron and steel exports as much. So the government might say iron and steel exports is 2%. Now, why is textiles at 7%? Why is iron and steel at 2%? There is no mathematical formula behind it. This is just a policy or a bunch of bureaucrats sitting back and deciding or determining that this is how the rates would be, which was actually one of the grounds on which India lost the case in the WTO about MEIS and SEI scheme benefits. Against which the ROT-DEP scheme, the ROT-TEP scheme as we call it, is supposed to provide a kind of a mathematically backed reimbursement of taxes, which will be a part of the total value of exports. And the kind of taxes that we are looking at, for which the scheme is going to actually provide an offset, the taxes are like electricity duty on usage of power, because that is not part of the GST structure. VAT or CST that is paid on fuel, which is used for transportation, stamp duties on export documents, mandi tax, if you are actually making use of that for procurement of raw materials, items of this nature, which are actually still outside the purview of GST, and therefore are what we call non-creditable indirect taxes and would necessarily form part of the total cost of goods for export. We are expecting that the government would actually provide a mathematical background to how much would be the percentage of benefit coming out based upon what is the proportion of these taxes in each sector or into each type of product. And that essentially is the big difference. So if you look forward as an ordinary exporter, if you look at ROD-TEP scheme, the scheme actually talk about maybe a benefit of 0.5% to 1%, as opposed to the MEIS scheme, which would probably be 3% to 5%. So there will be a radical reduction in the percentage of benefit that will come to you once you bring in ROD-TEP scheme in India. And that's the big difference.
Right, correct, absolutely. So I think, I mean, it's time to wrap up. We have touched most of the points, and we have touched very large, very wide spectrum of issues, in fact, and very comprehensive, coming from GCC to Cyprus to EU to, of course, the GST, of course, the AEO certification, the safeguard, and we have touched virtually every aspects of taxation, and we expect that post-COVID, the life is not going to be easier, for anybody who is in the business of business and things. But yes, hopefully, as some of the panelists have rightly suggested, that the things will be a little fairer, and the government is expected to be a little more considerate in terms of giving adequate support to the businesses, to revive themselves, to come back on the feet, and particularly the MSME sector, which is in a bad shape. Let us hope that, as per various surveys, almost about 40% of them have already downed their shutters, and that's a major area of concern. That huge loss of employment and huge loss of the base, the business enterprise base in the country, which will certainly shrink the size of the GDP for India. On the one side, we are looking forward to $5 trillion economy. On the other side, whatever we had achieved, it is shrinking. And that's an area of concern for the government and as well as for the businesses. So let me thank all the panelists, on also, the people who have intervened at the right time, Mr. Sridhar, Rishabh, everybody, and for your valuable time, and also, solid and useful words of wisdom and nuggets, which I'm sure the audience will love it and they will like it. And let me thank the audience for their patience and sharing valuable inputs at various points of time during this debate. And I hope to come up with more interesting webinars in coming weeks. So let me thank
thank you very much,
Mayank and Bishop Shah.
Thank you very much. Thank you very much. It was lovely. It was lovely hearing everyone.
It was wonderful connecting all of you. It was really wonderful connecting all of you. And of
thank
course,
you very much.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you. Thank you.
Thank you. Bye-bye.